our first topic today is all about stop management. Absolutely crucial for traders. I said it in the beginning, at Tradelo, we are fixated on managing risk. And part of managing risk is knowing exactly where that stop needs to be placed. So the objective of this topic, number one, is I want to introduce you to the principle of optimal stop placement with a very unique practical example. I'm then going to outline for you 6 techniques and considerations that are going to allow you to optimize how you approach stop placement. And then finally, I'm going to show you 3 strategies that I adopt, that I utilize day in, day out. And I'm going to show you how to apply those 6 techniques, or at least how some of those techniques and considerations factor into 3 different strategies. Okay, now the best place to start. The art to optimal stop placement is to place the stop where the trade strategy is no longer valid. That is the overarching rule of thumb when it comes to placing a stop, okay? There is no if or maybe or when or why. Stop placement is absolutely precise. Okay, one of the things that, for me as a trader that I spend a lot of time on, when developing back-tested strategies is I always choose an exact stop. It's never maybe I put it here, maybe I put it there. No, I optimize that stop and I always utilize that stop moving forward. Okay, so it has to be precise because everything we do from that point ultimately is impacted by that stop. And what I mean is when it comes to basic risk management, if you use a 10-tick stop, that will equate to you using a specific position size. Now, if you increase and decrease that stop, ultimately, your risk management is going to vary and it's going to change as a direct result. And what that means is if in some instances you bet, let's say, $100 per tick, and in some instances you bet $150 per tick, the reality is that you've got an inconsistency in terms of how you're applying your risk. And what that means is you're effectively saying that in some instances, your trade strategy has got a higher probability than other instances, which, as you can see, from a pure statistical perspective, makes no sense, okay? You have a trade strategy and you have to apply a consistent, constant amount of risk to it. Otherwise, what will happen in the long run is you're not going to allow the probability of outcomes to exist. Okay, now, a way to think about this, okay, come back to what I said. When the price trades and it invalidates your strategy, that's the point to exit. That's the overarching rule, and that's what you must be taking a note of. I exit the trade where the trade is invalid. Now, the way to think about this, if you bought the market, so let's say you long the market because you saw momentum coming in, okay, and you saw flow coming in. Now, if neither of those 2 variables exist, you should no longer be in that trade. Okay, and that's what we mean when there's an invalidation of the key principle that enabled you into that trade. When those variables are no longer present, you flatten the trade, you exit the trade. Okay, another example. If you sold the market at resistance, okay, in other words, previously the market went up to resistance and no one's willing to buy. So you long the market and you got out because effectively, no one wants to buy through there. The reality is if you suddenly start to see, sizable offers being lifted, okay, that means you need to stop out of the trade. Okay, you should no longer be in that trade because the very reason that you entered that trade no longer exists. Okay, we exit the trade when the specific trade strategy we are executing is no longer valid. And that's the key overarching rule. And that's what I want you to take away. Out of anything else of this chapter 2, that's what I want you to take. Exit the trade when the specific trade strategy we're executing is no longer valid. Okay, now, I want to share a little story with you so you can kind of go a little bit back and understand how I came to understand stop placement, okay, how we were taught stop placement when I started trading in 2011. Now, we had a very rigid approach to stop management. If you speak to any traders that were around the 2008, 2009 era, back then, we always used to talk about stop placement as, what's your stop that you use? Do you use 5 ticks? Do you use 10 ticks? Okay, that's how we spoke. Right? It wasn't a case of, I stop out because, there's no buyers in the market, or I stopped out because, it confirmed a close above a 52-week moving high. No, we had a stop that was relative to our account balance and relative to how much we could lose on the day. That's how stop management was defined for us. Okay, and there's a very good reason for it. Obviously, I was backed by a firm. Now, when a firm is putting their hard-earned money behind you, they need to know that you are using as tight a stop as possible. Okay, because the tighter the stop, obviously their money is safeguarded. So they didn't want us to lose too much of their capital. Okay, so we used to adopt very, very tight stops for that reason. The second reason we used to adopt a very, very rigid approach to stop management was it was a very simplistic methodology to teach traders. Okay, if I said to you, tomorrow, every single trade you do, use a 10-tick stop and nothing else, it's simple. There's no room for failure. There's no error. There's no reason to think. There's no discretion required. And in that, by the way, just so you're aware, as you'll come to understand when I tell you the story, that in its own is extremely powerful. Because remember, it's not the size of the stop necessarily that makes it powerful. It's the consistency of applying the same stop over time. That's what makes it work so well. Okay. Now, how I learned stop management was like this. Our mentor came in on day one and he said, okay, guys, today we're going to conduct price ladder drills. All right. Now, a price ladder drill was just effectively you get the price ladder up and you watch price. There was no charts. There was no backtesting. There was none of that fancy stuff. We literally just watched the price of the German Bund ticking up and down. So today's drill was simple. Every time we entered a trade, whether we bought it or sold it, was irrelevant. We had to immediately put a 10-tick stop. Okay. That was the drill. Enter, I buy, I put a 10-tick stop. And what we had to do throughout the day was observe the market. Observe what price is doing once we enter, and what does it do from that point. And at the end of the day, go and look at all the trades you took and understand and interpret the 10-tick stop. Did it work? Did it not work? When did it work? When did it not work? Why do you think it worked? Why did you think it not work? Okay. Now on day one, I walked away. I was like, this is stupid. I mean, how can you apply a 10-tick stop to every trade? That makes absolutely no sense. Okay, more importantly, I think I just lost money on the day. I was like, this is crazy. I mean, that's not, surely trading is not 10-tick stop. It makes no sense. On day 10 of doing this drill, so 10 days later, I actually realized that applying this approach works extremely well. When? Well, in momentum flow-driven markets. Okay. Equally, I also came to observe that in very slow-moving consolidating markets, it's a horrible trade strategy. Okay, because typically you're just going to get stopped out the whole time. And that is what makes this approach to, placing a stop so powerful, is that because you are fixing a stop, right? You're keeping it consistent. You're no longer thinking in terms of, oh, the market should do this or the market shouldn't do this. No, you're thinking, I got in, I put the stop. Now I'm observing price. And now I can go away and say, okay, well, I got long because it's a breakout. So let me observe price under that construct of momentum. Okay. And that's the key takeaway with having this rigid approach, is that in some instances, in some context, having a very tight stop of 10 ticks can work extremely well. Now, a key lesson on stop placement, and I want you to make a note of this. In flow-driven markets where there's momentum, we use tighter stops, smaller stops. Why? Because by the very definition, momentum means there's a lot of participation, which means when I partake, assuming I'm partaking at the right time, there should be others partaking at the same time as me, which means price should not be spending a great deal of time where I'm entering. So by definition, we can use tighter stops. When we have consolidating markets, low volatility markets, moving averages, moving sideways markets, there we need wider stops. Why? Because the market needs to search for willing buyers and sellers of liquidity. Okay, so tight stops we use in flow-driven momentum strategies. Wider stops we use in consolidating sideways moving markets. Okay, now note, this is why if you are a new trader in the first 3, 4, 5 years of your career, I would suggest you adopt flow-driven strategies. Why? Well, because what did I just say? I said in flow-driven momentum markets, we can use tighter stops. Okay, very, very important to understand this. When we are new to the job of trading, our objective, our sole priority is capital preservation. We don't want to be using wide stops. We want to use smaller stops. Moreover, when you can use smaller stops and trade flow-driven momentum moves, you can also learn to adopt leverage and the art form of executing with leverage a lot sooner. Okay, now, another way to think about this, I'm going to give you 2 examples. If you went and bought support, okay, a lot of traders like to trade support and resistance, and they all define support and resistance in different ways. But let's say you bought support. Okay, if we look at, for example, the DAX up at 15,500 on a daily chart, that's acted as support pretty much from March till now. For the last 7 months, the market's failed to break below there on a daily chart. Okay, so we can all look at that, and I'm sure we can all agree that there was support within that area. Now, let me ask you this. Let's say you bought it for the umpteenth time. Where do you place your stop and why? Okay. Now, the reality is, to this answer, I suspect you'll get 101 different answers. Okay, there'll be 101 reasons why people will place the stop where they place it. Some people will have a small stop. Some people will put a stop below a daily low. Some people will put a stop wide. Everyone will have a different reason as to where they place their stop. Okay, there's a lot of variability in defining the stop when it comes to buying support. Now, the opposite example of that is if you were to buy through resistance. So you're looking for a breakout. You can see that, for example, the gold market over the last couple of days is broken up above that daily trend line that we've had for the last 2 months. If you're looking to buy through that, where would you place your stop? Now, in this instance, we're probably only going to get 2, 3, 4, 5 different answers. Okay, because everyone that's trading a breakout is aware that volume, momentum, and price discovery are the 3 key principles that define a breakout strategy. Okay, so we would all agree that the point at which that flow and that momentum no longer exists, that's the point at which we need to start exiting that trade. Okay, so again, it's very, very important to understand why it's always recommended for younger traders still trying to build a career to rather look at flow-driven type strategies. Okay, they are slightly easier to manage in terms of risk early in your career, all right? Because there's a lot less variability. There's a lot less reasons as to why you'll place a stop, where you place it. Okay, now let's get back to the example of 10-tick stop, and let's see ultimately more about this overly simplistic approach. Okay, now it's not an optimal approach. I'll tell you that right now. Okay, but if you apply it in the right strategy, in the right context, it's very powerful. Okay, now I'm going to explain it to you in terms of why it worked so well for us as traders early in our career. When I started, it was the height of the European debt crisis. Okay, so think of the pigs: Portugal, Italy, Greece, Ireland, and Spain. Okay, they're all yielding 6, 7, 7.5% 10-year yields. All right, all of a sudden, Draghi came in and he saved the day. He said, "Don't worry, guys, I'll do whatever it takes." The reality is that at that time, what typically happened was that early in the morning, early in the session, a lot of big institutions would come in and they'd be very aggressively wanting to lift bunds. Why? Because German bunds were seen as a safe haven of Europe. Okay, so right on the open, there was a play that I'm going to show you now called the initial balance breakout. Okay, now how did it work? What you can see on the chart is 2 profiles. Okay, 2 market profiles. This is 1 day and this is day number 2. Now, the initial balance is this little black line on the left side. And what we can see is that on day 2, the initial balance was sat nice and narrow, and it was sat just before the previous day's high. Okay, and this ultimately was our trade strategy. What we did was we bought through the initial balance high. We used a 10-tick stop because what we expected is once it took out that previous day's high, which in this instance you can see is only 4 prices above the initial balance high, what we expected was the market to be volatile and snap to the upside. Why? Well, because in those days, no one wanted to provide liquidity in the market. In those days, the market was thin. In those days, it just took one little order of a couple of hundred lots to come through, and the market would move 10, 15, 20 prices. So the strategy of buying through the initial balance with a 10-tick stop worked very, very well because of the context in which it was being applied. Okay, structurally, this play was simple. Okay, if you try and apply this same strategy today, you will notice it doesn't work. Okay, initial balance plays do still exist. I would suggest most young traders look at the initial balance. But the reality is that this strategy itself doesn't work right now. But it's not to say that in the future, if all of a sudden the market dynamic changes, if things become volatile, that doesn't start to work again. Okay, now that ultimately is why that strategy worked so well for us. Now, the key takeaway from this example is that when we place a stop whatever the magnitude of that stop is, it must be suitable for the strategy we're adopting. And that's where we're going to go today. I'm going to show you the different ways that you can come to learn about what is that stop size. Where should you be placing that stop? Okay. If you can do that, ultimately, the game of trading becomes a lot more simplified. Why? Because then you never have to think about where that stop needs to go. Okay. The art to optimal stop placement is to place the stop where the trade strategy is no longer valid. Okay, so if the stop should be placed where the strategy is invalidated, we're first going to need to determine where our strategy becomes invalidated. And that's the hard part, right? There's not enough traders that understand this. If you want to learn about where the right stop is, you're going to have to go through the process called iteration. That just simply means do a trade strategy 100 times. And you'll master the art of stop placement, okay? If you were to take this initial balance breakout play and go and look at it 100 times over and go and measure, if I bought the initial balance high every single time and I used a 10-tick stop, what percentages of those, went on side? What percentage of those stopped me out? And you would have some very basic statistics, but that in its own would start to give you a very powerful understanding of what's possible and what's not possible, okay? And that's a nice lead onto what we're going to talk about today. And the first thing I want to show you, the first technique that you can adopt, and the first consideration I want you to think about when it comes to stop placement is what we call a backtesting methodology, okay? Now, don't get scared away, by the way. I'm by no means proficient when it comes to coding. So don't get afraid by this, right? Backtesting just simply means we want to take something, a strategy, an idea, and we want to go and generate an understanding as to whether or not we've got baseline edge. Okay, it boils down to that. You either have got some kind of edge or you don't. You've got some sort of a price directional bias or you don't. It is black and white. Okay, and that's why we use a backtest. It ensures that me as a trader, who's naturally always going to be, overly confident, it ensures that that confidence is grounded in statistics, in numbers. Okay, this doesn't have to be complicated, by the way, and I'm going to show you a very simplistic approach to doing very simplistic backtests. Now, important. A very general, simple backtest is important for two reasons, and I want you to understand this, okay? And don't take offense to what I'm about to say now. One, if you can't create a backtest for your strategy, you probably don't understand your strategy sufficiently, okay? And I know that's going to hurt some people, and they're going to say, oh, I know my strategy, I know what I'm doing. But the reality is, when you can backtest a strategy, okay, think about what a backtest is. The backtest is, tell me your stop, tell me your entry, and tell me your target. That's ultimately what you need to run a backtest. Now, if you can't do a backtest to your strategy, it's because you probably haven't defined sufficiently what your entry should be, where your stop should be, and what your target should be. Okay, when you can define with precision those three variables, I would say you're in a very, very powerful position. Regardless of, by the way, regardless of whether you got edge or not within that strategy, the important thing is that you have an understanding of ultimately where you should be entering your trade, where you should be stopping, and where you should be targeting. Okay, so that's the first thing. A backtest is an important litmus test. The second reason why we must be able to do a very simple backtest is it'll allow you to visualize and interpret your strategy, okay? So it'll ultimately tell you, do you have price directional edge or not? If you don't have price directional edge, you need to adjust. You need to change it until you get price directional edge. Now, what you can see in front of you is what we call the MAE, the MFE profile. Now, a lot of you, and I've had traders ask me about this, why in the Tradelo application do we not look at MAE and MFE? The simple reality is that looking at MAE and MFE as just a standalone statistic is a waste of time. It's something that I think a lot of these charting packages, they show you because it looks sexy. Tell a trader that, wow, if he executes this trade, look at his favorable excursion. You could have made 600 ticks if you just sat in the trade, and it sells well. I think it kind of gives traders an unnecessarily high degree of confidence, okay? The reality is if you can use the MAE and the MFE as a ratio, as a statistic, as a visual interpretation, then by all means, it starts to become extremely powerful. Okay? And I'm going to show you a little technique here. Now, on the y-axis, okay, what we've got is the adverse excursion. In other words, how far you go offside. Okay, as simple as that. If I enter the trade, how far did I go offside? Now, On the x-axis, we have the favorable excursion. How far did I go on side? Now, what you're looking at here is a backtest done for a trade strategy called open drive. Okay, if you've known me for a long time, you'll know this is one of my favorite plays. This is all about the open drive in the S&P 500. Okay, in order to create this backtest, we have to create a simple time-based stop. What do I mean by that? Simple sense. Okay, and you can apply this technique to any of your trade strategies. What you do is you run a backtest. You have your entry point. Okay, that you have to define. I enter at this point in time. Now, obviously, for the open drive, we enter in and around the cash open. So somewhere around 15 to half an hour after the cash is open in the US. Now, at that point, what we say is we don't know ultimately what our stop is. So we just won't have a stop. And equally, we don't know what our target is. So we just won't have a target. Instead, what we'll say is trade the entire session and exit me out of the position at the end of the session. Okay. Now, what this allows you to do is it allows you to see what that trade idea will do over a period of a session. And this is interesting because this allows us to visually see the journey our trade idea takes. Now, ultimately, this will allow us to understand what the ratio between our favorable excursion and our unfavorable excursion looks like. Okay, so we're going to do this for 3 reasons. This is the 3 things we're going to get out of this image. Number 1, as you can see by this chart, if we were to use a 0.4% stop, in other words, if I was to draw a stop line here, okay, straight away what you can see is we have, roughly speaking, a 52% win rate. And that in its own is a tick. Okay, 52% win rate's pretty good. So we're now imposing, because we can see from this chart that quite a few of our trades actually went a long way offside. Some of them went as much as almost 1.2% offside. Okay, so we can see a lot of our trades went well beyond the 0.4. But if we imposed a stop, we can see straight away that, well, worst case scenario is that all of these trades are going to get stopped out, but 52% of the trades we're going to win. Okay, and what that means is that if we apply this, we'll have a win rate of roughly 0.77. Okay, so if you were to go calculate the win rate on all of our winners, it will work out to 0.77. And if you divide 0.77 by 0.4, you get a win rate, or sorry, a risk reward of 1.92. Okay, so is a risk reward of 1.92 very good? Of course it is. Okay, we can simply establish this basic approach to placing a stop just by looking at the excursion of the market. Right? That's the first reason why we use this technique. The second thing we can see is the skew of our excursions. Now, we can see how skewed our excursions go, how far to the right our winners go, okay? And we can see how far up the page our losers go. And what we're trying to do with this is we're trying to understand, if I enter this trade for this reason that I'm entering, is my trade actually in fact showing me some sort of a favorable bias? Okay, what you don't want to see in this instance is you don't want to see lots of trades having adverse excursions relative to favorable excursions. You want to see skew to the favorable side, and you want to see obviously less to the downside, because that means you can partake in more of the trade ideas. Okay, and finally, the most important thing, we can all agree, if I just get rid of all these annotations quickly, we can all agree, just by looking at the simple image, where should we place the optimal stop for this trade strategy? Okay, well, we can very much quickly see that that is the optimal point, because it allows us to not lose the maximum on all of those, and we still get to partake in all of those. And that's the real key. That's the, the baseline of why we do this technique. It'll give us a very good idea that 0.4 is a very good starting point for a stop. Now, it's not to say it's optimal, by the way. 0.4 is not optimal, because as you'll see in a couple of minutes, there's other techniques we can apply to optimize it. Now, let's move on to another little image that I just want to show you, okay? What you've got here is, where is the maximum point that stop should be placed? And this kind of ties in very nicely with what I was showing you with the 0.4. And this is an important test to do and another technique to do, because it really allows us to start to understand the complex degree of relationships that exist between our stop size on the x-axis, on our first y-axis, our percentage of profitable, so how many of our trades win, and on our y-axis, our net profit, okay? Now, why we do this is very simple. There is an assumption, there is this idea that the wider our stop is, the more likely it is, or the more breathing room our trade strategy has. The reality is it doesn't work that way, because there's an interchange between the wider the stop. Obviously, when I get hit on it, I'm giving up more. But equally, we don't always necessarily get greater winners or bigger targets as a result of using wider stops, okay? So we have to find that relationship between the size of the stop, the percentage of the time our trade's going to win, and the ultimate net profit, okay? And that interchange point you can see is in this little red area over here, okay? You can see somewhere in this area around 30 ticks is where we get the significant drop off. If you see the red line, that's our net profit, right? As we increase our stop from 10 to 20 to 30 prices, we get quite a significant drop off in net profit, even though our win rate is increasing. Okay, and that's what's something that's so misleading. I see so many traders say, oh, my win rate's 50 or 55. Who gives two hoots? The win rate's irrelevant. What matters is how many dollars you make. Okay, so it's that relationship. Sure, you want to have a high win rate, but you need to have a high win rate relative to a high net P&L. That's really crucial to understand, okay? Just looking at baseline statistics is not going to crack it in this job. You've got to find that interrelationship between, if I increase the stop, what does that do to the net profit and the win rate? If I decrease the stop, what does that do to the net profit and the win rate? Now, crucial. It's not about imposing the stop at peak win rate, okay? Oh, sorry, at peak profitability. I see traders doing this too often. It's fitting, okay? The reality is, you're never going to capture, in this example, 500,000 of profits. It doesn't work that way, okay? Because you get things like slippage, you get things like volatility shifts in the market, okay? It just doesn't work that way. You have to find that kind of middle ground. You have to sacrifice a little bit of that net profit, okay, to make sure that you get a sufficient amount of winners coming through. Why? Because remember, the more winners you have, the less volatility you're going to have ultimately in your equity curve, right? So it's a balance. It's a balancing game. But the point is, again, the same with the MAE and the MFE technique. We can apply this technique where we use our net profit and our win rate combined with our stop. And between those three, we can start to see that, again, our stop is somewhere between that 30 to 40 prices. Okay. Are you starting to get an idea of how this optimization works? I know it sounds complicated, but it isn't. Okay, now that's the first technique, a backtest. Simple charts, MAE versus MFE. The second chart is our win rate plotted with our stop size with our net profit on the trade. Okay, that's the backtesting techniques. Now we're going to move on to a volatility assessment, because like I said to you, it's all good and well me showing you this chart and saying, oh yeah, look how much money I made. I made 500,000 profitability. Was that in a low volatility environment or a high volatility environment? Because the reality is, when there's volatility, more of your trades are going to get stopped out. Okay, so that win rate is going to drop off quite aggressively. And when your win rate drops off aggressively, guess what your net profit's going to do? It's going to sink even more aggressively. Okay, so we have to, when it comes to determining stop placements, we have to have some sort of a variation when it comes to applying volatility. Now, what you can see is we've got two indicators that you can apply to your charts that'll enable you to understand when we've moved into a volatile regime. Now, it's not just a case of, oh, today was a volatile session, therefore, my stop should be 40 ticks instead of 30. Okay, now, for the rest of the session, I'm going to keep referring to 30 or 40 tick stops, because that's the example we're using and carrying from the backtest. Okay, so what we need is an indicator that's going to show us when the market's in fact moved into a higher volatility regime. The two things you can use. Number one, an ATR. Very simple, average true range. Place the indicator on your daily charts. It'll just show you the range of prices. Okay, the market's trading 80 ticks today, 90 ticks tomorrow, 100 ticks the next day, 60 ticks the next day. It simply just shows you the degree of prices over which the market is capable of trading. Okay, now, when we have got a wider ATR, okay, then we obviously need to use wider stops. We need to adjust that stop. So rather than having a 30 tick stop, we're going to be better off adjusting to a 40 tick stop. Okay, because remember what I said to you. It's not that a wider stop necessarily gives you more profit or more loss. It doesn't. A wider stop will impact both your win rate as well as your net profitability. And if you go and test your strategy in a higher volatility regime, what you're going to find is that because you're giving it that extra degree of stop, ultimately you are having a higher net profit as a result. Okay. And again, you need to establish this. It's not to say that it'll always be that case. In some strategies, particularly more flow-driven strategies, wider stops make sense. Okay, if you're trading for example, something like support and resistance, high volatility, you don't want to adjust the stop, because the reality is in high volatility situations, there's no liquidity, which means you're more likely going to get stopped out anyways on that wider stop, which means your net profit will sink down. Okay, hopefully that makes sense. The point is ATR, and then most importantly, go and put on a moving average. Smooth out that ATR, go and look what that moving average line looks like, and determine when you move into a greater volatility regime, how do you adjust that stop? Okay, so it's not to say you always adjust the stop. It's to say when you run the back test, run it to include volatile sessions so you can understand what works in volatile sessions versus not volatile sessions. Okay, the next thing to consider, and this is a wonderful technique. I was actually taught this by a fund manager, and this is typically used by swing traders. This is typically used by investors, people who typically stay in trades for longer, who look for bigger risk reward plays. Okay, so if you're someone that looks for bigger plays, typically this is kind of a technique that you definitely want to start applying in terms of stop placement. Okay, now it's called price confirmation. Why? Because most traders that I know simply exit when a price is traded. Okay, in other words, the strategies become invalid, they now exit the market, or maybe it's traded below a certain price and it's triggered their stop. So people use these sort of price-defined stops. What price confirmation is ultimately is that the trade is only exited if the market closes beyond a certain price in time. Okay, and a perfect way to look at this example is on a daily chart. If the price closes beyond a certain price, then I'll exit. As opposed to if it just trades the price, I exit. Okay, that's what price confirmation is when it comes to stop management. Now, from experience, some strategies benefit from only exiting trade when it trades that price. Okay, think of a breakout. You don't want to be hanging around. Why? Because there's positioning in the market. If you're going to wait 2-3 hours to see if the breakout was good or bad, the reality is you're going to get taken out of the markets. Okay. However, some trades where you're looking, maybe we've gone into price discovery mode, perhaps the market's now in a 52-week, it's broken out of a 52-week range, and suddenly it's starting to trend. In those instances, price confirmation stops work very, very well. Okay, so again, think of price confirmation as being applied to some strategies, but not others. Okay, it's not to say you apply it always. You apply it in some instances. Why? Because it gives you an optimal approach to stop placement. Now, the best way to explain it is with the chart in front of you. This is the German DAX, and this chart was pulled on the weekend already. So what you can see is a consolidation move in the DAX. This is a daily chart. This is the last 6 months from pretty much March this year all the way up until date. Okay. Now, what you can see is that there was a break below this range. We can see 1, 2, 3 times, very, very nice support. And all of a sudden we broke below that day. Now, in this instance, what we don't want to do is we don't want to simply be setting a stop if the market trades a certain price, like 15,550, because we can see if we did that, we would have been stopped out and the market would have driven lower. Okay. Moreover, if we did it a second time, the market would have stopped out and would have driven another 500 points lower. Okay. The reality of the situation is that in this instance, because we have a larger time frame play, because we've broken out of this price consolidation move, it makes absolute sense to rather allow the market to close on a daily basis back inside above the 15,500 range. At that point, exit the trade. But until then, if it trades the price, so what? Now, I know a lot of you are going to say there is a risk to that, which is true. The risk is that you're probably going to have to take maybe 20, 30, 40, 50 ticks more stop. But the reality is what you'll find when you go and backtest this, when you go and look at this and you go and apply it to the right types of strategies, the times where you do have to pay up slightly more, okay, those instances will add up over time. Sure, maybe 5, 6, 7 times you pay up a little bit more, call it 50 prices, they equate to 350 prices. The time that the market comes up and stops you out, let's go back there, the time that the market comes and stops you out at the absolute high and then drops 500 points, that one time that you could have still been in the trade because you used a price confirmation stop will make up for all the other times where you had to take a little bit of extra stop. Okay, so that's how you have to think about it. Stop placement is an art form. It's sometimes you got to be precise. Sometimes you need to wait for price confirmation. Okay, that's the second technique. Now, this is an interesting one. This is one I added in after having a discussion with some of the traders on the floor here. And this is this concept of symmetrical versus asymmetrical reward. Now, how I want you to think about this. So you're doing a back test and you're learning certain things about your back test. You're getting an idea of where that sort of roughly idea of where that stop should be. What traders don't consider in the equation is the reward structure. Okay. Now, there's a fixation on this idea that a good trade has a 2-to-1 risk reward or a 5-to-1 risk reward. And sadly, this is just marketing hype. It's rubbish. Okay. A good trade is anything around 1-to-1 risk reward. Okay. And I'll show you why in hopefully in part 3 of this of today's session. I'll show you why statistically 5-to-1s and 10-to-1s is a lot of rubbish. Okay, the reality is if you go and look at a distribution of winners, or you go look at just a basic distribution of how profitable trade could be, the excursions of a trade, what you're going to find is very typically they actually don't very frequently have very high win rates. Okay, so in 1-to-1, 2-to-1, that's more or less where 70-80% of your distribution will fall. Okay, occasionally you'll get the outlier. Occasionally you're going to get the 10-to-1 and the 20-to-1. But the reality is the probability of that happening is so low, and you don't want to be fixating yourself on high risk reward. Okay, what you do want to be thinking about is what is the shape of the profile of your strategy. In other words, what is the risk reward profile look like? Now, in a basic sense, if you look at the chart, think of this red area as your stop size. Okay, let's use our example, the open drive, and let's say it's 30 prices. If my potential reward on average, my target is somewhere around 50 prices, okay, that's not a great example of asymmetrical. Let's do an example of asymmetrical. Let's say my average price was around 100 prices, okay? In that instance, I've got a 3.3 risk reward, okay? A bit of asymmetry in the profile of the trade strategy I'm taking on. Now, it's very, very important that when you are working out your stops, you must know whether or not your trade strategy has got asymmetrical opportunity, symmetrical opportunity, or a risk where the reward is less than the risk you're taking. You need to know this. Why? Because if your trades have got very asymmetrical reward, you need to give the trade as much breathing room as possible. Why? Because that trade is going to be offering you very big winners when it works. Okay, so it's almost a case of saying, if the markets are offering you big winners, don't stop yourself out prematurely just to save an additional 0.1%. Because the reality is the opportunity cost that you're giving up when that trade wins is so great. Okay, think about it. I got stopped out because I was being stingy on the stop. The reality is the market's giving me 300 ticks. Okay, you don't want to miss out on those really big winners just because you're being too tight on the stops. And that needs to factor into optimal stop placement. Don't be afraid to give that little bit of wider risk for the asymmetrical trade opportunities. Okay, let's talk about the symmetrical ones. This is where the example of the open drive, where we've got something like a 35 tick stop, and we've got, roughly speaking, call it a 50 tick target. Okay, a little bit more symmetrical in terms of the risk reward profile. Now, in these instances, okay, we have to be more specific and intentional on our stop placement. Okay, we can't afford to give too much away in terms of the stop. Why? Because remember that relationship I told you when it comes to stop placement. It's not just about using a wide or a narrow stop. We have to factor that in, and we have to include into that equation what's our win rate doing as well as our net profitability. Okay, it's the combination of those three. Now, when our reward is more symmetrical, the reality of the situation is we can't afford to use wider stops unless, of course, it's going to give us a significant increase in our win rate, okay, and profitability. So very, very important. When it comes to symmetrical opportunities, you can be more precise in your stops. You don't want to be giving away too much. And then the final one, where we have more risk on the table than the ultimate reward, we have to be very careful there. Okay, think of algorithms. Think of these sort of open orders at the open of the S&P 500, where we're just looking for a little bit of extension of the initial balances. Those kind of plays where very much we're kind of 1-to-1, less than 1-to-1. We're just doing quick scalps here and there. Those sorts of plays, there's absolutely no room. Okay, it's got to be tight stops. It's got to be 3-tick stop for 4-tick winner or 3-tick stop for 2-tick winner. We cannot mess around with that because every tick we give away there additionally is going to skew that net profit ultimately in the long run. Okay, so start thinking about the symmetry of your trade strategy. Is it a big winner you're going for with your trade strategy? Is it a small winner? In the big winner instances, the price discovery trades, the breakout trades on the weekly time frame, those are the ones you must give more breathing room to. When it's tight, small little, opportunities to win, that's where we need to tighten up that stop and not be afraid just to use very, very tight stops. Okay. Now, let's move on to stop order type. Another thing not many traders think about, and they should be. All right. When it comes to stop placement, we also need to know how are we stopping out. Okay, and this is not something people talk about because they've never actually experienced the consequences of when this goes wrong. And I can tell you firsthand, when this goes wrong, it's going to hopefully not be too expensive for you. Okay, now most of you will assume that if you put a stop, it gets triggered. It doesn't work that way. Okay, and it doesn't matter what market you're trading. Yes, in most instances, you'll put a stop at 5 and you'll be stopped out at 5. But in some instances, 99% of the time, you'll be fine. But in some instances, 1% of the time, you're going to find that two things can happen. There's two very, very big risks that I'll outline for you. One is called order skipping, and one is called stop market liquidation fills. Now, before I explain the practical risks, okay, what is a stop limit and a stop market order? All right, in a very simple sense, if you look at the image here, at 24s, I've got a stop limit order. Okay, what that says is if the market comes and trades one contract at 43.24, stop that order out. Okay, buy out of that market. Okay, it doesn't matter if it's one contract, doesn't matter if it's 100 contracts, it buys me out of the market and I just get out at the price 24. All right. If, however, I use a stop market order there and someone comes in and they ultimately buy 24s, so someone comes and let's use the real example. Let's say someone buys 500 contracts at 24s. Okay, right now on this ladder, someone's offering 233, which means there's a difference of 267 contracts. Now, what that suggests is that person who just bought the 24s will also fill out the 24.25s, and they'll also get some of the 24.50s. In other words, they'll get filled over all three of these prices by simply buying 500 contracts at market. Now, what that means is if I'm using a stop market order, I don't get the 24s. I get after this guy's been filled. Okay, so I'll get the next available price, which will be 43.2475. Call it slippage. Okay, I get 3 ticks of slippage. Now, that might not seem like a lot, but when you think of a 20 contracts in the futures on the full S&P, times by 1250, times by 3 ticks, okay, that can be quite expensive. Right? It can be an extra $800 I have to pay up for what? Just because I use a stop market order. All right. So what are the two risks? And I'm going to explain them to you. One is called order skipping. And the best way to think about this, I'm going to actually keep with this example because then I can keep coloring in on the price ladder. Okay. So what is order skipping? Let's come back to this guy that's bought 500. Let's say this guy, rather than 500, bought 1,000 contracts. Okay. The market jumps over. So he gets filled at 24 quarter. He'll pretty much get filled or something like that. So he'll take all the liquidity within the next 10 prices. If I've used a stop limit order here, the market's going to jump over me. Now, remember, I told the market I will stop out at price 43.24 and no other price. That's the limit I've set, which means I don't get filled. Right? And the only way I get filled is if somehow the market comes back to me and stops me out. Okay. Now you can see how that's risky. Imagine I'm fast asleep at night. I come in the next morning and the S&P is another 3% higher. I haven't been stopped out because of order skipping. In terms of a stop market, there's also a risk because let's use that same example. Right? That guy comes in. Again, he buys 1,000 lots. And in this instance, he takes out the 10 ticks. He gets filled first. Okay. Now, if anyone was in front of me at the 24 stopping out, let's say this was a really big resistance area. Okay, think of just a massive resistance area, triple top on the daily, and everyone's put their stop at 24s. Okay, if everyone else has put their stop at 24s and so have I, and someone buys 1,000 lots before then, what's going to happen? He gets filled there. Then everyone else that's in front of the queue in front of me, let's change the color. They'll get filled there, and then poor me gets filled over there. Okay, so yes, I've got a guarantee I'm going to get stopped, but I've got no guarantee at which price I get stopped. And typically, because we little people in the markets, we will never be early in the queue. We'll always be last in the queue. And that's why we call it a market liquidation fill. Basically, we get the absolute shittiest, worst price. That's how it works. Okay, so where does this leave us? Well, it's important you understand the risks of both stop limit orders, stop market orders. Okay, they are not without risk, and you need to know those risks. More importantly, you need to apply the right stop to the right strategy. Like I said to you, if you are deciding to trade support and resistance, you've got to be very, very careful about using stop limit and stop market orders. Okay, I would go as far as to say, if you are trading support and resistance and you are selling resistance and you do choose to stop out beyond the level, you're better off just using a stop limit order, because the reality is a stop market order, you're going to get the worst price anyways. Okay, equally, if you use trading in sideways markets, low volatility markets, markets that are consolidating, the reality is in those instances, you don't want to pay up liquidation fills. You would prefer to use stop limit orders. Okay, so very, very important. Think about which order type you're going to apply to your specific strategy. That's the key takeaway, because there is an optimal choice. Okay, let's then move on to another thought that comes to stop placement, and it's all about psychological considerations. Again, rarely spoken about. Who talks about psychology and stop placement? That's just silly, right? Your stop should never elicit an emotional response. Okay, when you put that stop in the market, you should not feel uncomfortable. In fact, what you should say to yourself, you should almost smile and go, wow, yeah, I'm going to lose $1,000. That's okay, because I can make $10,000. That's the feeling of inertia you need to have. You need to have that positive emotional response when placing that stop. If you don't, if that point at which you're placing the stop feels uncomfortable, the position size is too big. Okay, that's as simple as that. If you're putting that stop and that's the place that your strategy says you should put the stop and it feels uncomfortable, you're simply just trading too big a position. Okay, you know what to do. Equally, a stop is never ever placed at a point where the loss is acceptable. So do not change. Remember what I said to you. If the strategy says use 30 ticks, but you feel comfortable only losing 20 ticks because the P&L makes sense, right? You never put a stop where the P&L feels comfortable. You always put the stop where the trade is invalid. Okay, you've got to get that the right way around. Stop placement is first. P&L management is second. It's the byproduct of where we put the stop. Okay, another point. Our stop placement is crucial for us to build trust. Right? You have to trust where you're putting that stop. You've almost got to say to yourself, when that strategy exhibits itself, you got to put that stop in and go, okay, cool. Shouldn't come back here. If it does come back here, it means that there's something else going on in the market. And that's the confidence that comes from using the right stop. You trust the approach you're taking to executing your trade strategy. Okay. A way to think about stop placement is that ultimately it must remove emotion from the equation. When you put that stop there, it's an acceptance mechanism. It's saying, if I get hit there, the trade stopped out. It is what it is. I was wrong. But you know what? I'm not going to think about that, because I'm thinking the upside. I'm thinking, I've got this opportunity now, and the risk of being in that opportunity is what it is. Okay. Our stop placement is our absolute worst case scenario. That's how you have to think about it. And you must be comfortable with that worst case scenario. Okay. The way to think about it, and this is one of the key things I really love in the Tradelo application. On your risk manager, we've got this sort of barometer called allocated risk. And your allocated risk is effectively your absolute worst case scenario in the day. In other words, in this example, it says, Brannigan, your worst case scenario today is you're going to lose $2,500. That's your worst case scenario. If everything goes wrong, if you get every single trade that you've currently got live wrong, that's it. That's what happens to you. Now think about it. If this was, let's say, a $100,000 account, would you be emotional about this? It's 2.5%. Okay. Sure, it's money, and we always need to respect the fact that it's money, but we're comfortable with it because we've allocated that risk. We've kind of put our chips down. We take the risk, and now we can focus on the opportunity. Right? It allows us to be emotion-free because we accept the risk we've allocated. Okay. Finally, and this is a key point, a stop is a discrete point in an otherwise continuous flow. In very simple English, the stop is the signal that what you thought is in fact wrong. Okay, and if we're wrong, we need to use this as an opportunity to learn from the trade. The stop is a wonderful thing because it's a discrete point. And what it does is it allows you to become objective again. Okay, I'll never forget a lesson I learned from another trader. I was in a cafe having a coffee and we were discussing the morning's trade in the bunds. And I said to the guy, I stopped out of most of it, but I kept 2 of the bunds on, because with a wide stop, I think it'll come back. And he looked at me and said this, and I'll never forget this. He said, what is the point of holding the 2 lots? And he was kind of trying to understand my logic, trying to understand what I was thinking. I said, well, I think I'll make some money back. I think it just went a little bit far. I think it's a bit oversold, one position. It should just come back a little bit so I can make a couple $100 back. And he said to me, I'll never forget this. He challenged my thinking. He said, when you hold any position, no matter how small, you are biased in your objective interpretations. In other words, what he was telling me was that because I have those 2 lots on, it's impossible to be 100% objective. And more importantly, I would never have the ability to sell that market that day because I was biased in my original thinking. In other words, the mere fact that I have any position on and that I didn't stop that means I'm biased. And I will never be able to sell that market simply because of that bias that exists. Okay, so think of your stop as that relief mechanism that says, bang, you stopped out. Okay, go away, think about the next opportunity, because that's what it is. A stop is a relief mechanism. If you didn't have a stop in place, think about the longest trade you've ever held for 2, 3, 4, 5 days. Think about how continuously exhausting it is thinking about that trade. It's continuously in the back of your mind. There's that pressure and that continuous, thought of, will I lose, won't I lose? So that's what the stop allows us to do. It allows us to be 100% objective. Okay, let's summarize there. So 6 different thoughts, techniques, approaches to defining and learning about optimal stop placement. Okay, backtesting methodology. You can use the MFE and the MAE, as well as combining your stop size with your net profitability and your win rate. Factor in volatility. Okay, make sure you use an average, a moving average of your ATR, and factor in volatility. Okay, determine whether or not you're going to use price traded stops or price confirmation stops. Make sure you've thought about, is the trade strategy got symmetrical upside or asymmetrical? And again, give yourself the additional stop if it's asymmetrical. Keep the usual stop if it's symmetrical. What stop order type are you going to use? Stop markets, stop losses. Okay. Finally, what are those psychological considerations? Factor those in. All right, those are the 6 summary points from this topic number 2. Now, I can see the time, like I said to you, a long topic discussion, but let's get to 3 examples. Okay, I'm going to spend another 10 minutes, take you through 3 trade strategies I execute day in, day out, just give you a rough idea of how that stop works, why we place the stop, where it's invalid, and ultimately just thinking about some of those 6 different thoughts that we've discussed over the session today. Okay, coming back to this chart. You saw this chart earlier. This is the DAX 30. And the trade strategy we're talking about is a consolidation breakout. Okay, so very simple. When markets enter sideways mode, and again, this can be applied to any time frame, when they do consolidate for a long period of time and have very clearly defined support and resistance, at some point we're going to have a breakout. Okay, now this typically works a little bit better the longer the time frame, because I wouldn't be looking at this on a 1-minute chart. It does sometimes work, but it's a lot more noisy. All right, now in terms of entry, what we're looking for here is a confirmed break. Okay, the topic of this is not to tell you how I enter it, how I stop out, how I target it. That's not the point of this. The point is to get you to understand what is an optimal stop and what goes into thinking about an optimal stop. Okay, so in terms of entry, we're looking for a confirmed break. We've got our confirmed break right over there. Okay, let me change the color of the pen quickly. Now, at that point, we want to enter the trade. Now, where does the stop go? Okay, and that's the key thing. Now, you can backtest this in any number of ways, but the first thing I want to think about before I come back to the stop is I want to think about the risk to reward. Okay, in terms of the reward, well, we've got a very large time frame breakout of a consolidation pattern. Now, if you go and look at enough of these patterns, remember what I said to you, iteration, that's the only way you're going to learn to do this. What you'll typically find is that consolidation ranges typically extend by the size of the range, typically. Okay, so that's a typical. Sometimes it's more and sometimes it's less, but typically in terms of a distribution, you should get, roughly speaking, this range is 1,000 points. Okay, now if we know the reward straight away, in terms of stop, we can see we've got an asymmetrical opportunity here. right? There's a really good opportunity to win. So we want to factor that in. We can afford a wider stop because ultimately we're looking for 1,000-point winner. Okay, now the way I said to you, imagine I said this to you, step aside and you and I were just having a conversation. I said to you, look, I got this really good trade. It's in the DAX. It's a 250 tick stop and it's a 1,000 tick target. What do you think? Okay, I think every trader would say to me, yeah, that sounds like a really good profile, a really good opportunity. Okay, and if I then showed you the chart and you looked at it and go, yeah, I would take that trade. The strategy makes sense. The structure makes sense. We've had the breakout now. It's closed. But yeah, I think that those metrics, those numbers add up. Okay, do not make the mistake in these consolidated breakouts to use too tight a stop because you're not factoring in ultimately the symmetry of the trade. Okay, what order type would we use? Okay, again, in terms of the stop, in this instance, for this trade to be proven invalid, I would need to see that trade close back inside this consolidation range. Okay, now in this instance, for it to close back inside this range, we're going to need a lot of time frame participants to get involved on the buy side. Okay, so in essence, I'm more comfortable using a stop limit order here. Okay, equally, in terms of whether I use a price traded stop or I use a confirmation close stop, in this instance, again, I'm going to use a confirmation stop. I want the market to close back inside that range. I want to give it as much time as possible to prove me invalid before I exit the trade. Okay, and then finally, where does that stop go? In this instance, we can place our stop above the previous day's high. Okay, that is effectively the signal. That is the breakout day. If you do enough breakout strategies, that's a very, let me rephrase. If you do enough breakout strategies on a daily time frame, that is an optimal place to place a stop. Why? Because that's the day ultimately that all the large time frame participants are getting involved in that trade idea. Okay, again, like I said to you, it's not to say that that is the way. It's not to say that that's the perfect methodology, but that's an optimal approach to determining a stop for consolidation breakouts. Okay, another example. And this was on Friday in the gold. This is a 1 minute time frame. And what we're looking for here, the strategy is called overbought 2 standard deviation moves. Very simple. When a market gets beyond 2 standard deviations on a daily, and we have a liquidity event, which you can see down here. Let's change color pens. At that point, what we're looking for is a fadeable opportunity, a fadeable trade. Okay, now let's ignore the stop for now, and let's talk a little bit about the target. Okay, in terms of target, what we're looking for is a retest of where the liquidity event started. Okay, now in essence, this trade failed, and it's important I show you the failure so you don't think I always win and never lose. In essence, this was the liquidity event, and the market did pull back, so there was a favorable excursion on this. But as you can see, we had a secondary move in that liquidity event, which was another $12. So quite a significant failed trade here ultimately. But the point is our target was retesting the liquidity event. Okay, so we were looking for, roughly speaking, an $8 opportunity. Okay, so we know we've got $8 of opportunity, but in terms of volatility, this is a very high volatile trade strategy. Okay, so ultimately, we now have to factor that into our trade strategy. Now, because there's more volatility, we need to use a wider stop. Okay, we need to use such a wide stop that if you were to go and run a back test on this, you would see that typically speaking, you get around 1.5 to 1 risk reward for this trade strategy. Okay, what we're looking for is when that liquidity event is in, we want to stop above where that liquidity event peaks. Okay, we're not entering at the peak. This is not me showing you getting in at 20.3. No, you're typically going to get in on a first candle close, right? So you do have a stop that looks a little bit like that versus a target that looks a little bit like that. Okay, so in this instance, a little bit of a wider risk reward simply because of what was happening on the day. But as you can see, there's a very good reason for what was happening on the day. There was ultimately more to come. Okay, so again, we factor in the symmetry of the opportunity. We factor in the volatility. In terms of the stop type, the order type, yeah, we are going to use a stop market. Why? Because as you can see, when the market gets very, very volatile, in this instance, I don't want to run the risk of skipping, of order skipping. Okay, so in instance, the stop goes above the high. We use a stop market order here. Yes, I'm going to get slippage. Yes, I accepted that in this instance, there was about 6 ticks of slippage. But the reality is I need a degree of guarantee that I get stopped out of this. Why? Because remember, my symmetry in here isn't great. Okay, I'm looking at 1.5 to 1 in terms of risk to reward. Right, so I can't afford for this trade not to get filled out for a loss. Okay, and then the final trade strategy. Some of you would have heard this. This is poor structural highs and lows. You see this quite often, particularly when the markets die down. They become quite tight and they don't move much because no one's interested in trading. And ultimately what we're looking for here is just a resolution of that. So we're looking for the market just to resolve, this poor structure. Now, again, in terms of how we enter this, we look for something called access methodology. In a very basic sense, not going to go through in this discussion. This is all about mass participation. It's something we track and develop quite extensively in the Tradelo trading group. But access methodology ultimately is a timing signal. It's a timing mechanism. Okay, think of it as if you saw a bearish engulfing candle just before we were about to go resolve the structure, you would use that as a timing signal that in actual fact participation is in the market. Okay, so we use it as, for lack of a better word, a price action signal to get short. Okay, once that bearish engulfing comes in, we get short the market, we look for the extension. Now, because tight markets, these sort of very, very, poor high, poor low structures, inevitably, they very rarely extend. Okay, if you go look at the maximum favorable excursion versus the adverse excursion, what you'll notice is that the targets are very, very small. Okay, they typically have got very, very, very much a skew towards the adverse excursion. Okay, point is, yeah, ultimately, we are going to need a wider stop. Okay, we take the stop the size of the axis candle. And again, in terms of the order type, we're going to use a stop limit order. And in terms of the target, we're just looking for an extension. Okay, so we've got a very much, in this instance, symmetrical opportunity, and sometimes even looking around 0.7 to 1 risk reward. Okay, one final note on trade strategies that have got less reward than risk. Don't be afraid of them. Okay, just think of, a lot of traders when they out there on Twitter land and YouTube land, they talk about 2 to 1, 3 to 1, 4 to 1, as if that's normal. It's not. It's rubbish. It's not what's normal. In chapter 3 today, what I'm going to show you ultimately is what a normal distribution look like, and that's pure statistics. Okay, so that's coming from a backtest, and it'll show you exactly what that distribution looks like. Let's finish with a quote. The art to optimal stop placement by now, after the hour, is to place the stop where the trade strategy is no longer valid. Okay, there are 6 variables that go into determining how to make it optimal, but ultimately the stop goes where the trade is no longer valid.